Hey everyone, welcome back to another episode of my Magic Formula portfolio series where I'm building a portfolio using the Magic Formula as made famous by Joel Greenblatt in his book, The Little Book That Beats the Market. And the general formula, it's very simple. It just looks at all the stocks in the market and then compares them using two metrics: return on invested capital, or ROIC, and then earnings yield, which is like the relative cheapness of the company. It looks at how much earnings it has relative to the actual price. So ideally, you're getting the cheapest, best stocks when you look at the Magic Formula Screener, which is actually a free resource that you can look at over on magicformulainvesting.com, which we can see right here. I use it to get my stocks. And once you log in with a free account, you can set your minimum market cap. I use $50 million, and I am doing the top 30 in this sort of index that it creates on magicformulainvesting.com. So if we hit get stocks, it'll pull up the list, which I've actually moved over into the spreadsheet, which I have in the description below, where you can see all of the moves that I've made within this portfolio, because up until this point, I've been doing monthly, not really rebalancing, but if a stock falls off the list every month, I was taking it out of the portfolio. And then if a new one was added, I added that one to the portfolio. So there was quite a bit of churn, actually a surprising amount of churn, at least when I was going into this. I didn't really know what to expect. Granted, there are many, many different stocks out there. So I guess you'd expect some movement, especially quarter to quarter, when return on invested capital might look very different with one company to the next. So anyways, and plus there's price swings that will change the earnings yield quite a bit for some companies. And that could easily take it off the list or add it to the list if you get a short-term swing 1 month versus another. So that's what I was doing. But now that I have about 6 months of decent data looking at this sort of churning strategy where I'm rebalancing every month because I'm doing it within an IRA on this platform, M1 Finance. Go ahead and check out M1 Finance if you're in the US. It is a free brokerage that has some really nice features, especially when it comes to rebalancing and kind of automation. They have this great auto invest feature where you can just add money to the account and it will automatically put it towards the underweight sections of your portfolio. You set a target allocation and it will try to meet that. And I actually just did a rebalance for this portfolio. And I'll get into the reason why I did that rebalancing in just a second. But if you want to check out M1 Finance, I have an affiliate link in the description. If you fund your account, I might get a small commission, which would help out the channel a lot. So please do check that out. It is a pretty nice brokerage after all. But I mentioned that I rebalanced the portfolio, meaning that any holdings that were overweight were sold off a bit or trimmed down. And then any holdings that were underweight or new, those had money added to them to bring them up to their target allocation, which for most of them was 4%. And I had a few down here that I left at 3%. I mainly actually focused the pharmaceutical stocks in the list down to the 3% allocation, because I have a suspicion that pharma stocks probably are kind of the flaw or one of the flaws of the Magic Formula investing strategy when you're just looking at pure metrics. But I mean, don't take this as financial advice because this is more of a hunch. And it's that a pharma stock might have a really high return on invested capital number 1 year, but then the next year it might fall very quickly because they might have had some hot drug release or something like that. And there hasn't been a chance for copycats to come out or something like that. I think you see a lot more short-term swings with some of these high return on invested capital companies. And it goes beyond just pharma too. But I do think pharma in particular is susceptible to that. But it's more of a hunch. So do your own research in any event when you're investing in any stock using the Magic Formula strategy or otherwise. But if we go over to the spreadsheet that I've put together, which is in the description below if you want to check that out, we could see that about a third of the portfolio, if you were to equally weight everything, is in pharma stocks. There are a few on here that didn't make it onto my portfolio because they aren't on M1, mainly Alt Global Holdings, Franklin Wireless Corp, and Interfor Corp. So those are not in my personal Magic Formula portfolio. Depending on what brokerage you use, you might have access to these. I just wanted to keep this pretty simple using M1. It's a brokerage I like. It's very easy to use. And I don't want this to be a cumbersome sort of adventure. I want this to be easy. And to that, the monthly rebalancing strategy was pretty cumbersome. I had to do it every single month. And because there was quite a bit of churn and putting together the spreadsheet as well, it just was kind of annoying for what I was really trying to do with it. But I was using the opportunity to collect some data to see if the churning strategy actually actually helped. Because it's in an IRA on M1 Finance for me, that means that any short-term gains or short-term losses don't affect my taxes in any way because it is within a tax-sheltered account. With a traditional IRA, which is what this is, I put the money in pre-tax, so I get a deduction that year. I don't have to pay taxes on that income. But then when I go and withdraw the money at some point down the line, once I reach 59.5, I would have to pay my regular income tax rate on that money. So it's paying taxes later, essentially. And I would ideally use this money towards some sort of charity or something that's tax deductible anyways by the time I pull it out of this account, but you never know what the future may hold. But in any event, I thought that the churning sort of strategy would be potentially better because then you're always buying the cheapest and best stocks. And the reason I did that, even though the book doesn't directly call for it, is because the book's rationale for holding the stocks for 1 year, which is what Joel Greenblatt says to do. You hold these Magic Formula stocks for 1 year, and a year later you check to see if they're still on the list. If they are, you keep them. If they're not, then you take them off. And the reason he called for that 1 year rationale was because of long-term capital gains taxes, which are typically much lower than short-term capital gain taxes, which in the US is your marginal income tax rate, which often is higher than the long-term capital gains tax rate. But we'll see what happens. Taxes are always subject to change. But that's typically how it works, and that was kind of the main rationale. And plus, you give the stocks a bit of a runway to grow if you get a good winner, but you could kind of say on the flip side, you also give the stocks opportunities to fall as well. So my hunch was that it would slightly outperform perhaps a longer-term hold strategy. But let's take a look at the data that I have over these last 6 months. So if we go back to March 2021, this is when I started the portfolio. This was when I was doing 50 holdings, not 30. I decided to try and keep it very diversified and also to collect some data, of course. Technically, I think 30 would have been better, but hard to say exactly. I didn't differentiate between the top 50 and 30. I probably should have in hindsight, but oh well, this is what I have. So I did a very cursory sort of analysis where I looked at the initial share price, which is a new column I've added here, and then I have the current share price, which is updated live using the Google Finance plugin on Google Sheets, which is a nice little perk. So anyways, it shows how much the return would be, not including dividends. So just price appreciation over the previous 6 months if I were to have held these 50 stocks and not done anything, or almost 50, anything in bold was not on M1, so I couldn't buy those. So if you look at the returns here, you see a pretty broad range. I believe Michael's here. I don't think I ever got my money back there when I lost it because I think they merged, or I don't think they went bankrupt, but I don't know. I lost that share for some reason, so I don't think I got any value out of it. I think there was another one kind of like that. It was MSGN became MSGE through a merger. I don't know if I lost any value there, so I just used the MSGE stock ticker in its place, and that was a small negative return. But anyways, when you average all of these returns together, I assumed equal weighting at the very beginning, so there wouldn't be any effects of having large positions versus small positions theoretically. Again, we're not including dividends, so this is a cursory sort of analysis. But if we just look at the price appreciation, we actually had a positive 0.59% return over the 6 months if I were to have held all of these stocks, which I didn't. There was a couple on here that weren't on the list. And plus, I was churning through these holdings every single month, and a lot of these didn't make it to the 6-month mark that we're at now. A number of them did, but many did not. But if we go back to my Magic Formula portfolio, you'll see that I've actually lost about 2%. This is a money-weighted return, which is a different sort of measurement. Because I've been adding money to this account, again, cursory sort of example here, we're comparing not money-weighted to money-weighted. So take that with a grain of salt. And this also includes dividends. So even with dividends, though, fact of the matter remains, I am down. It was a negative return by a couple percentage points at least, and that's when you actually include dividends too. If you remove dividends, it's even worse, probably down 3 or 4% based on this money-weighted return. But it's not positive, and even without dividends, the other strategy would have been positive, which is really saying something. Because sure, you might think, okay, wait a second, 2-3% difference, who cares? That's hardly anything. Well, who cares about that? Well, 3% compounded over many years is quite a bit of money. Let's go over to a compound interest calculator. So here on moneychimp.com, we could do a quick compound interest calculation. We'll say you start with $1,000, you don't add any money, you give it 10 years to grow at a 7% rate, which is the average historical rate in the stock market. If you're in a broad index, that's what it's been doing. We'll see if it does that in the future, but we'll just use 7% as our benchmark. You're just about doubling your money. You're gaining $967 just in appreciation thanks to that compounding effect. But okay, let's do 10% instead. That's a 3% difference after all. How big of a difference does that make? Well, you just added another $600 in gains. And now instead of being a double, it's more like 150% return just from beginning to end. That is a very substantial difference. And of course, if you kick out the timeline even further, it's going to keep getting bigger and bigger. That compound effect adds, the 3% itself compounds too. So it's not as simple as just like, oh, it's only 1 or 2 or 3%. Who cares? That can really add up over the long term. So I want to take that pretty seriously. Granted, it is only a 6-month sample size, which could be too short, but I think, especially given all the comments you guys have been giving me, you guys really don't like the fact that I've been doing the monthly rebalancing. I thought it was a noble, worthy experiment to do. I was curious, and plus there wasn't a ton of money at stake, at least yet. So I wanted to go ahead and try it. It looks like that probably wasn't a very good idea. I wonder how much transaction costs really went into that. There might be a bit there. M1 Finance is commission free, but as you know, every brokerage has to make money somewhere. So you're paying for it in some way, whether it's through direct commission fees, whether it's through order flow, whether it's through membership fees, you're paying something along the way, or you're just getting a bad bid because you're doing a market order. In the case of M1 Finance, it is what it does. It does batch orders at market levels, if I'm not mistaken. That's exactly how it does it. So you're probably not getting the best price on a given stock. Just if we're talking about doing a limit order through a traditional brokerage or through M1 where it does fractional shares and all that. It's a trade-off. You get the benefit of being able to do fractional shares and not having to buy a full share, which makes it great for balancing, but you're probably paying for a slightly heftier share per share of each stock. It totally depends on your priorities and what you're trying to do. I do think M1 Finance is really easy to use, and it also looks really great, which is helpful for YouTube, but again, not a real reason to invest in a brokerage. It is easy to use though, so I will give it that. So I went ahead and made the changes for September. As you can see here, the green ones were added. We added BioDelivery Sciences. We removed Hibbett. Anything in red is removed. We added Immersion Corp. We added Masabi Trust, which I think is an iron ore company. So we'll see how that one does given the recent Evergrande news in the Chinese real estate market, which uses quite a bit of iron, and China in general uses a lot of commodities. So we'll see what happens to this one in the medium to short term. I imagine things won't be too rosy unless iron ore prices skyrocket again. But anyways, it's kind of beside the point. So we added Masabi. We removed Sleep Number Corp. And we added Smith & Wesson. So now we have 2 gun companies, which is interesting that both of them happen to make it onto the list. And we removed Unisys, and then we also removed Waiter Holdings, which wasn't actually in my portfolio anyways, because it wasn't on M1. But after I added those holdings to the list, I hit rebalance on M1 to make everything equal again. So we kind of have a new starting point for this portfolio because I'm not going to be touching these stocks for the coming year. So I want to see what happens now, since it looks like holding stocks for the longer term. I know 6 months wasn't necessarily the best sample size, but I think it's pointing in the right direction, that you probably should try to hold the stocks for longer rather than doing the kind of cycling through for whatever reason, whether it's because it's cutting off winners, whether it's because of transaction costs, whether it's because of whatever. I don't know the exact reason, but it's probably something along those lines. I'm going to let these stocks run. But because I hit rebalance, I did have to trim some of my winners a little bit to get everything back down to even. So Surface Oncology, we had a partial sale of about $40. We also had a partial sale for Co-Diagnostic Inc. and Catalyst Pharmaceutical. They sold a few bucks each. Otherwise, everything else was added to that was in the M1 portfolio. And that's where we're at now. I'll include a link to this specific portfolio if you want to use it on M1 Finance. M1 Finance allows you to copy the portfolio, which is a nice little feature too. If you want to share something with your friends, you want to show them what your portfolio is. It's not financial advice by any means. None of my content is, but if you want to use it as a start, you want to adjust the portfolio or do whatever you want, that is there for the taking. I'm just blindly copying magicformulainvesting.com. So if you want to do the same, then this could be an easy way to do it, at least for the month of September 2021, because the list is always changing. So that's pretty much it. I've decided to commit to just holding the stocks, seeing how they do, and trying to hold it at least for a year. We'll check back in a year to see if they're still on the list. If they're not, then I'll remove them most likely. And if they are, then I'll leave them in the portfolio, trying to follow more closely with the Magic Formula Investing book. That is the little book that beats the market. And also to appease some of you guys in the comments who really were vouching for me to do that, and I think with good reason. I'm not saying that it was stupid by any means. I was just trying something out, wanted to see how it worked. Looked like it's probably not working and probably won't be worth it for the longer term. I mean, we'll see. I'll definitely be tracking the data either way to see what happens here with this portfolio. I'll be giving updates still every single month, showing you guys the performance just so you guys can follow along. Maybe this is something you want to incorporate in your portfolio in some way, and I think it's helpful just to have some of this data out there to see if the strategy still does work in this day and age, if it's worth putting the time and effort into it. Though it is a pretty straightforward strategy in that you're just following a screener list pretty much, and that's about it. But whatever you want to do with it, I hope this can be of some value just to see how this portfolio actually performs. I'd love to get your guys' thoughts in the comments below. If you think this is a good idea, if you think I'm pulling the trigger too quickly, would have preferred to have more data of me cycling through the stocks. Theoretically, I could do it again next month and go right back to churning. But if you guys don't want to see that and you like this decision instead, definitely let me know. I'd appreciate your thoughts in any event. And if you like this sort of content about investing, whether it be in stocks, I have a lot of content about real estate as well, or pretty much everything as it has to do with personal finance, be sure to subscribe since I put out new videos every single week and wouldn't want you guys to miss out. And like I said, I'll continue to do updates on this series every single month on the 28th of the month, at least that is US Central Time. So wherever that is for you, that is when I'll post an update on this portfolio every single month. And check out the free stuff and the affiliate links in the description below. But until next time, take care.